The Federal Reserve's reverse repo facility just dropped to $180 billion. 2 years ago, it held $2.3 trillion. That's not a drawdown. That's a liquidity evaporation. And it's happening while Treasury auctions are showing the weakest foreign demand since the pandemic began. This is not a coincidence. This is the dollar system running out of buyers. If you want to understand the financial plumbing before it breaks completely, subscribe now and get ahead of the crisis. Most people have never heard of the reverse repo facility. That's by design. It's part of the Federal Reserve's overnight lending operations, technical, boring, invisible to anyone not working in fixed income markets or monetary policy. But it's one of the most important pressure valves in the entire dollar-based financial system. Here's what it does. When there's too much cash in the banking system and not enough safe assets to park it in, institutions like money market funds deposit that cash at the Fed overnight in exchange for Treasury securities as collateral. It's essentially a parking lot for excess liquidity. The institution gets a small interest payment. The Fed gets to absorb excess reserves. Everyone's happy. It's a sign of excess liquidity. Too many dollars chasing too few safe assets. At the peak in mid-2023, the reverse repo facility held $2.3 trillion. That was a historic anomaly, evidence of how much money the Fed had injected during the pandemic and how few attractive alternatives existed for that cash. Money market funds were flooded with deposits. Banks were flush with reserves, but with interest rates at zero and bond yields suppressed by QE, there was nowhere profitable to deploy that cash. So it piled into the reverse repo facility. $2.3 trillion, sitting overnight, earning minimal interest, waiting. Now it's down to $180 billion. That's a $2.1 trillion decline in less than 2 years. Let me say that again. $2.1 trillion in cash has left the safest overnight parking spot in the world and gone somewhere. Where did it go? And why does that matter? Because that cash didn't disappear. It moved. And where it moved tells you everything about the stress building in the dollar system. Here's what's actually happening under the surface. When cash leaves the reverse repo facility, it means institutions have found other places to deploy that money. Normally, that's a sign of economic health. Banks are lending, companies are borrowing, credit is flowing, markets are functioning. But right now, we're not seeing healthy credit expansion. Corporate loan growth is anemic, small business lending is contracting, consumer credit is tightening. So where did $2.1 trillion go? Into Treasury bonds. Here's the mechanism. The Federal Reserve has been running quantitative tightening, letting bonds roll off their balance sheet without replacement, effectively withdrawing liquidity from the system. At the same time, the U.S. government is still running trillion-dollar deficits, which means they need to issue massive amounts of new Treasury debt every quarter. Somebody has to buy those bonds. Foreign buyers, historically the largest and most stable source of Treasury demand, are stepping back. China has been a net seller of U.S. Treasuries for 8 consecutive quarters. Their holdings have dropped from over $1.1 trillion in 2021 to under $800 billion today. Japan is under pressure to support the yen and can't keep recycling trade surpluses into dollars the way they did for decades. Saudi Arabia and Gulf states are diversifying reserves into euros, yuan, and gold. Belgium, often used as a proxy location for Chinese purchases, shows declining Treasury holdings. The international bid is weakening. So domestic institutions are being forced to absorb more and more Treasury issuance. Banks, pension funds, insurance companies, money market funds, they're drawing down their reverse repo balances and buying Treasuries because there's no one else. This is what the $2.1 trillion drawdown represents. The forced conversion of safe overnight liquidity into longer duration, less liquid Treasury holdings. It's not expansion, it's absorption under duress, and it's a sign of stress, not strength. Now layer in what's happening in the broader credit markets. Corporate bond spreads, the extra yield investors demand to hold corporate debt instead of Treasuries, are widening, not collapsing, not spiking into crisis territory, just gradually, persistently widening. That means credit markets are starting to price in higher default risk, higher refinancing risk, higher fundamental uncertainty about corporate ability to service debt. Investment-grade corporate bonds that were trading at 80 basis points over Treasuries in early 2024 are now at 120 basis points. High-yield spreads, junk bonds, are widening even more, from 300 basis points to over 450. Why does this matter? Because rising spreads mean borrowing costs are increasing for companies even if Treasury yields stay flat, and higher borrowing costs mean lower profitability, which means weaker corporate fundamentals, which means higher default risk, which means wider spreads. It's a feedback loop, and it's happening while the Fed is still holding $7 trillion in assets from quantitative easing. Think about that. The Fed spent years buying bonds to suppress yields and support markets. They're now trying to unwind that by letting bonds mature without replacing them, but they're doing it slowly, letting maybe $60–80 billion roll-off per month, because doing it faster would crash the market. Meanwhile, the Treasury is issuing $2 trillion in new debt per year. The math doesn't work. The Fed is withdrawing liquidity through QT. Foreign buyers are withdrawing. The reverse repo facility is drained. But Treasury issuance continues at historic levels because the government is running trillion-dollar deficits that show no sign of shrinking. Someone has to buy those bonds, and the someone is increasingly a smaller and smaller pool of leveraged domestic buyers who are less and less capable of absorbing unlimited supply without demanding higher yields. Let's go back to 2019, before the pandemic, before QE infinity, before any of this was on anyone's radar. In September 2019, the repo market, the overnight lending market where banks and institutions borrow against collateral, suddenly seized up. Overnight lending rates that normally traded around 2% spiked to 10% in a matter of hours, 10% for overnight money, in the most liquid, most important funding market in the world. Why? Because there wasn't enough liquidity in the system to meet end-of-quarter funding demands. Banks needed cash to settle trades and meet regulatory requirements. Cash wasn't available at any reasonable price. The market broke. The Federal Reserve had to intervene with emergency repo operations, injecting hundreds of billions in liquidity over a period of weeks to prevent a full systemic freeze. It worked. The crisis was contained, markets stabilized, but it was a warning shot. It showed that the post-2008 banking system, with all its regulations and capital buffers and stress tests, was still structurally fragile when it came to short-term liquidity. The system was one bad day away from seizing up completely. Now fast forward to today. The reverse repo facility, which acts as a liquidity buffer, a shock absorber for the system, is nearly empty. Treasury auctions are showing weak demand and declining bid-to-cover ratios. The Fed is running QT, withdrawing liquidity. Foreign buyers are stepping back, credit spreads are widening. We are setting up the exact same conditions that caused the 2019 repo crisis. Except this time, the Fed's balance sheet is already bloated at $7 trillion. Their capacity to intervene without reigniting inflation is severely limited, and the global dollar system is under more stress than it was in 2019 because of geopolitical fragmentation, sanctions weaponization, and active de-dollarization efforts by major economies. The next liquidity crisis will be harder to solve than the last one. Here's the irreversible dynamic now in motion. The dollar's role as the global reserve currency depends on two things: liquidity and stability. Foreign governments, corporations, and investors need to be able to access dollars easily, park them safely overnight, and trust that the system won't collapse under stress. That's what made the dollar dominant for 80 years. But right now, the mechanisms that provide that liquidity and stability are weakening in real time. The reverse repo facility is drained, $180 billion remaining out of a $2.3 trillion peak. Foreign treasury demand is falling. China selling, Japan constrained, Middle East diversifying. Credit markets are tightening, spreads widening, lending contracting. The Fed is withdrawing liquidity through QT while the Treasury floods the market with new issuance, and the U.S. government is still running massive deficits with no political will to cut spending or raise taxes. At some point, and we don't know exactly when, but we know it's coming, the market's ability to absorb that debt without demanding significantly higher yields breaks. When that happens, you get one of two outcomes. Outcome 1, yields spike. If 10-year Treasury yields go from 4.5% to 6% or 7%, it crashes asset prices across the board. Stocks fall because discount rates rise. Bonds fall because yields are rising. Real estate falls because mortgage rates spike. Trillions in wealth are destroyed. Pension funds go insolvent. Insurance companies can't meet liabilities. The financial system faces existential crisis. The Fed is forced to intervene with more QE, more money printing, to cap yields and prevent collapse. But more QE reignites inflation, destroys the dollar's purchasing power, and accelerates the global shift away from dollar-based reserves. Outcome 2, the Fed holds rates down artificially. They cap Treasury yields through massive bond purchases, unlimited QE, yield curve control, whatever it takes. Markets stabilize. Asset prices hold. The immediate crisis is averted. But the cost is dollar credibility. If the world sees that the U.S. cannot allow yields to rise to market clearing levels, that the entire system depends on Fed manipulation, trust in the dollar as a neutral reserve asset collapses. Foreign central banks accelerate diversification into gold, yuan, euros, anything that isn't dependent on Fed intervention. The dollar loses reserve status not through crisis, but through abandonment. Both outcomes end with gold and silver repricing higher because both outcomes represent dollar system failure. The only question is which path we take. So what does this mean for you? If you hold cash, you are holding an asset whose liquidity infrastructure is weakening and whose value depends on maintaining confidence in a system under extraordinary stress. If you hold bonds, treasuries, corporate bonds, municipal bonds, You are betting that the Fed can manage this transition without either spiking yields or destroying the currency. If you hold stocks, you are assuming that corporate earnings can grow fast enough to offset either higher interest rates or currency debasement, and that multiples won't compress when liquidity disappears. None of these are safe assumptions right now. The reverse repo collapse is not something that gets fixed with a policy tweak or a press release. It's a symptom of a system running out of natural buyers and running out of capacity to generate real, productive liquidity. Let me explain what I mean by that. Real liquidity comes from economic growth, from businesses creating value, from productive investment generating returns. Fake liquidity comes from central bank balance sheet expansion, from money printing, from financial engineering. For the last 15 years, we've had mostly fake liquidity. The Fed printed, markets rallied, everyone got rich on paper. But that fake liquidity is being withdrawn now through QT. And the real economy isn't generating enough organic liquidity to replace it. So the system is running on fumes. And when liquidity dries up, when the reverse repo facility is empty, when Treasury auctions fail, when credit spreads blow out, asset prices don't adjust smoothly, they gap, they crash, they reprice violently in a matter of days or hours. The investors who survive these moments are not the ones holding the most leveraged positions or the highest flying growth stocks or the longest duration bonds. They're the ones holding the assets that don't depend on liquidity provision to maintain value. Gold, silver, hard assets that have intrinsic worth independent of financial system function. Let's talk about what smart money is doing right now. Ray Dalio's Bridgewater Associates has been publicly vocal about the risks of debt spirals and currency crises. They've been systematically rotating into inflation-protected assets, commodities, and gold. Bridgewater's all-weather fund, designed to perform across all economic environments, has increased real asset allocations significantly over the past 2 years. Paul Tudor Jones came out in 2024 saying he's long gold and Bitcoin because he sees fiscal dominance, government spending without constraint, as the dominant macro force that central banks can no longer counteract. Stanley Druckenmiller, one of the greatest macro investors of all time, has called gold the best investment in a world where central banks have lost control of the fiscal side of the equation. These are not permabulls. These are not gold bugs who've been saying the same thing for 40 years. These are investors who made billions reading macro shifts before consensus forms, before the media catches on, before it's obvious to everyone, and they're all positioning for the same thing, dollar system stress leading to hard asset repricing. At the institutional level, we're seeing similar moves, just quieter. Pension funds, CalPERS, Teachers Retirement System of Texas, major European funds are increasing real asset allocations from 0.2% to 5.8% of portfolio. That might not sound like much, but when you're managing $500 billion, an 8% allocation is $40 billion flowing into commodities, infrastructure, precious metals. Endowments, Harvard, Yale, Stanford, have been adding gold and inflation-linked investments as strategic portfolio hedges. Even insurance companies, traditionally the most conservative allocators on the planet, are increasing exposure to real assets because they're modeling what happens to their bond portfolios if yields spike or currencies debase. The signal is unmistakable. The institutions with the longest time horizons, the most sophisticated risk models, and the fiduciary duty to preserve capital across generations are moving away from pure financial assets and into things that hold value when monetary systems break. Here's the moment of truth. You are watching the dollar-based financial system exhaust its buffers in real time. The reverse repo facility was a shock absorber. It's gone, down 93% from peak. Foreign treasury buyers were a stabilizer. They're stepping back. China selling, Japan constrained, Middle East diversifying. The Fed's balance sheet was a backstop. It's tapped out without reigniting inflation that's already running hotter than official numbers admit. What's left is a system running on fumes, sustained purely by the belief that somehow the largest debtor nation in history can continue issuing unlimited debt without consequence. That belief has never been supported by history. Not once. Not ever. Every reserve currency eventually loses its status. The British pound, the Dutch guilder, the Spanish real, the French franc. Not because of military defeat, not because of revolution, not because of some external catastrophe, because of debt, inflation, and the gradual erosion of trust in the currency's stability and the issuing government's fiscal discipline. We are in the late stages of that process for the dollar right now. The debt is unpayable. The deficits are structural. The political system is incapable of making the necessary adjustments, and the rest of the world is building alternatives, BRICS payment systems, bilateral trade agreements, gold accumulation, because they see what's coming. The investors who recognize this early, who position before the crisis becomes undeniable, are the ones who preserve wealth through the transition. Not because they're pessimists, not because they hate America or want the system to fail. Because they're realists who understand that monetary systems are not permanent and that transitions are inevitable. Here's what you do. You reduce your exposure to dollar-denominated financial assets that depend on liquidity and leverage to maintain value. You increase your allocation to assets that hold value independent of credit markets, central bank interventions, and Treasury auctions. You prioritize physical gold and silver, not ETFs that can be fractionally reserved or contractually settled in cash during a crisis. Physical, allocated, deliverable metal. For gold, aim for 5–10% of your liquid net worth as a baseline, 10–15% if you're seriously concerned about monetary system risk. For silver, add another 5–10% because of the industrial demand dynamic we covered in the previous video. You build this position before the next liquidity crisis, before the next Treasury auction fails, before the Fed is forced to choose between market collapse and currency collapse. Because once that choice is made, the repricing happens overnight. One day Treasuries are trading normally, the next day yields gap 100 basis points higher, and the Fed announces emergency interventions. By then, gold is $4,000 per ounce, silver is $60, and the opportunity to buy at current prices is gone forever. You also consider geographic diversification, holding some assets outside the dollar system entirely. That doesn't mean you have to move to Switzerland or open accounts in the Cayman Islands. It means owning gold stored in Singapore, Zurich, or Toronto through allocated storage programs. It means holding some assets in other currencies, Swiss francs, Norwegian kroner, Singapore dollars, not as speculations but as hedges against dollar-specific risk. And it means understanding that the dollar's problems are structural, not cyclical. This isn't about the next recession or the next election. This is about a 50-year monetary experiment reaching its natural conclusion. $2.3 trillion, down to $180 billion. The buffer's gone. The buyers are stepping back. The debt keeps growing. The math doesn't work. And somewhere, in a conference room in Basel or Washington or Beijing, the people who run the global financial system know exactly what's coming. They're preparing. Central banks are buying gold. Sovereign funds are diversifying. Smart money is moving. The only question is whether you'll see it coming before the headlines tell you it already happened. Because once the liquidity crisis hits, once Treasury markets seize, once the Fed is forced to choose between inflation and deflation, between market collapse and currency collapse, the repricing will be instant. And the people holding dollars, bonds, and financial assets will be asking what happened, while the people holding gold and silver will already know. The warning signs are here. The reverse repo facility is empty. Foreign buyers are gone. The system is running on fumes. And the only question is whether you'll position accordingly, or whether you'll be asking what happened after it's already over.